So let's get into the first one. So, as we reflect on kind of the environment today, boards are facing, a shareholder environment that rewards acquisitive companies. It seems like companies are accumulating cash reserves, and they kind of have a mandate right now, it seems like, to do more M&A, more transactions. Do you find broader macroeconomic considerations material helpful in considering your acquisitions, or how do you pick it up? Rocky?
I think what you described is sort of the environment of Motorola Solutions. We've been fairly acquisitive over the last several years. The board has encouraged it. The cash is available to do it, so we've done that. If the question's kind of about, there's a sort of cloud hanging over, there's this recession that's going to happen any moment. I don't know that really impacts our view of deals. When we look at the business case and we put the business case together, we're looking for growth companies. So, to say that they're not going to start to grow makes it a little bit difficult. I think we're optimistic about the future, I guess maybe is what you look at, and the businesses that we look at are growing.
Good. James?
Yeah, I was going to say, I think we think a lot from the strategic objectives, and I think economy comes into play a little bit, but probably not as much. I mean, we kind of have our key areas that we want to focus on as far as acquisitions. We have talked a little bit about timing the market, but it's like really hard to get right. And I think there's also that temptation to buy bargains, and there's cases where good things can happen to bad, or bad things can happen to good companies, which that's an opportunity if the market's in a downturn. But there's also sometimes cases when the market downturns, there's a reason why this company is not doing very well. And that's something you have to be kind of thoughtful about too. So we definitely look at it very conservatively on that end for a tech company.
All right. Andrey?
Yeah, I mean, I would say right now macro environment is probably, we call it neutral, right? It's valuations are high, but many people want to sell at the same time. We want to own assets forever. So we're looking for through cycle, long-term growth profile of the business. But being a public company, nobody wants to step into something that craters next year. So there is sensitivity to that. And there's this convention that digital M&A software, it's all only growing from here. There's still a cycle, right? You kind of need to look at those second order insights, like, well, if it's some sort of process manufacturing automation and it's driven by cheap shale gas in the US and reshoring of that manufacturing, that's cyclical, right? So yes, it's software, but it will still be
Yeah, we talked about this before earlier, and it's interesting. Not many of our clients, when we get engaged to help with transactions, actually make that part of the analysis that we do. So it's interesting to hear, the reflection across different companies and how it doesn't seem to be a big driver for kind of what they want to assess when they're doing this. Picking that up a little further, then, as you think about kind of digital acquisitions specifically, what do you guys look at in terms of financial or non-financial metrics? How do you pick it up, and what are you looking for? Andrey, would you take us through kind of your thinking?
Yeah, I mean, at the end of the day, I think our duty to shareholders is to generate returns, right? So financial metrics will still be front and center, and we believe everything is quantifiable at the end of the day. It may be uncertain, you may need to think about scenarios, but it's quantifiable. Now, in digital, and especially given the valuations environment, I think sometimes you may take creative kind of lenses of how you look at it. For example, make versus buy, for us, a very often a relevant lens. So we would think, okay, if we strategically, we know we need that capability, we can develop it organically, knowing we start from kind of a lower base. It will take a long time. It will be risky in terms of execution certainty. It will be costly. And sometimes that valuation for a digital asset may be actually, well, it's cheaper and safer, right? And also thinking more creatively about what does it really get us? Not just kind of basic synergies, cross-sell, but it's you can create a better mousetrap, a new-to-the-world solution by merging, in our case, we're an industrial manufacturer, by merging software or some sort of sensorized digital offering with an equipment that wasn't there before. You're just creating new streams of value.
Right.
There's defensive play sometimes, like you have equipment and it's controlled by software, and it's, let's say, kind of agnostic, and if your competitor buys that, it kind of creates problems for your installed base. So there are lenses to look at. in the end, it's a little slippery slope. You always need to tie it back to kind of, well, what do I have to believe in to drive returns for shareholders?
Right. James?
Yeah, I think a lot of ours is similar in ways we think about customer impact. And so I'll give a short example of a company that was a technology acquisition. This tiny little company called Timely, which does that great problem of when you're trying to schedule a meeting, it looks at everybody's calendars and tells you what's free. That's part now of our Google Calendar system. But at the time we were looking at it and saying, we're going to need to spin up this group. We're going to have to build it inside. We started building, bringing some engineers in. And then we saw Timely, and it's like, we can just bring this in. It's already plugged in. It works. So it was an accelerator from a technology standpoint. The other half of that equation is that we look at engineers as a key asset in our company. And we actually encourage engineers to move around a lot. So once the Timely folks had kind of come in, done their little thing, and gone off, and now they're spread across several parts of the company, and a couple of them are actually working on some very interesting other problems. We see that as another way to kind of look at the return. So it was time to market, customer value, and then a group of talented engineers. And we actually baseline the engineers that come in through acquisition versus flat out recruiting, and they actually do a little better. So that's been a way for us to kind of even quantify that, yeah, we paid a little bit more, but we actually are getting a little bit higher return. They get promoted a little faster. They tend to be more key contributors. So it's another way for us to kind of look at the equation, not just the pure financial.
Right. Interesting. Rocky?
Yeah, I think when we look at acquisitions, we look at the financial implications of it, and we're constantly modeling out what are the revenue streams, what are the synergies that we can achieve with it, and I think like Andrey said, sometimes you have to get a little bit more creative with how you look at it, and some of the opportunities may be a little bit riskier, and you have to factor that in. But at the end of the day, when we go to management, they're looking for what are the financial implications that this acquisition is going to achieve, what's the return that they're going to get, and then we work with the businesses because ultimately the businesses need to own it, whichever one is sponsoring the acquisition.
Great. And just following up on that, one other question around that. So what seems to resonate most with your boards? Rocky, is it back to what you said, it's all about the numbers, or are there some other things when you're doing these digital acquisitions that are maybe smaller that they really kind of hone in on?
I think, it starts with the strategy. There's a conversation with the board around what the strategy is and where the areas that we're looking to go. Which areas we may need to do inorganically and which ones we're going to focus on organically. The return is a key component of it. But then with the strategy, some of the acquisitions that we do provide a platform that that allow for additional growth that maybe hasn't been included in the business case because it may be a little bit further out. But it creates a platform that we can grow in addition in new areas that we may not be if we were just doing it organically.
Got it.
It's interesting. I mean, for our threshold for this something to come to the board, it has to be pretty high. And definitely at that level, it's something that we're looking at for innovation, doing something different. We still have kind of this heavy bias for thinking about how we impact billions of users and what that means. I mean, search is such a big yardstick to kind of compete with. So that's part of the calculus that comes into it is will it improve search or will it improve kind of our Google Apps perspectives? So from that end, it's how you have high impact is definitely a key thing when it gets to the board level. At a lower level, we definitely are thinking about speed and time to market, customer value. Sergey likes to say, if it passes a toothbrush test, it's something that you use every day. That's always something key to think about. So, if we're doing that and kind of making that as part of people's lives, then that's probably a good idea to work for.
Yeah, first and foremost, board will be looking, in our case, are we building a better business, right? Like we're not looking to just slap together some, a bag of digital assets, right? So does it really enhance, are you becoming a better competitor, right? And then, do we know what we're doing? Are we stepping too far outside of the core, clearly? And then financials, right? So it's kind of strategic intent first, and then returns.
If you're interested in additional information on innovation and M&A, I encourage you to check out the Transaction Advisors Institute, which is a robust source for knowledge on M&A best practice.
We host a series of M&A conferences, run an elite M&A academy, offer M&A masterclasses, conduct M&A research, organize the M&A Leadership Council, and publish a prestigious M&A journal.
Members of the Transaction Advisors Institute include corporate executives, board members, and private equity investors that are interested in understanding the critical issues impacting transaction planning, structuring, and execution.
I encourage you to get more involved in the Institute.
Let's take a couple of quick questions if we have any. Interestingly enough, the bulk of our clients when we get hired, it really is about the financials. And I think probably because we do mostly larger transactions, right, where they're looking at big mergers or multi-billion-dollar acquisitions. So that it really is about the analysts are looking, they're publicly traded, the analysts are looking for what are you going to save, how's this going to improve our bottom line. And so, it is interesting to see how you pick it up a little differently. Questions?
I'm going to kick it off then with a quick one. James, when you talked about valuation per engineer, is there a pretty sophisticated view you think that's developing as to what that value is per engineer, and is it bifurcated, that certain engineers are worth X and certain versus Y? And so any additional detail that you think would be helpful for us to think about as we consider that metric would be helpful?
I definitely think that right now we're kind of going through that thought process, because I think as we looked at some of our core products, like a hardware engineer definitely has a different skill set than somebody who's a search algorithm expert. So we are realizing that there are some kind of different verticals that make more sense to have different, I would say, levels of engineering or thinking about it that way. But I think we really do try to encourage engineers to be very fungible across the organization. We find that if we actually want to bring in a new engineer, we actually have them work 3 projects in their first year just to see different things. And then they can kind of pick, like, okay, I want to go work on Android, or I want to go work on search. The other side is that there was a financial component there that I want to kind of come back to, is that if I can impact search, which is advertising, then that has got large numbers. And I remember somebody coming out to one of our campuses and watching a bunch of engineers playing volleyball, and the person was like, why are you letting this happen? They were just like, this does not make any sense to me. And actually I knew one of the engineers who was playing volleyball there, and that one had managed to save 10 seconds off of some of the back-end queries for search, and he can play volleyball for the rest of his life, from my concern. But the interesting thing there is that's how he thinks, and so yeah, it is a different yardstick to think about. But we do definitely think about different types of engineering, and we have had we do bifurcate right now between hardware and software, but we are thinking about different types of software engineers, because like an AI engineer is going to be different engineering than somebody who's kind of working on the enterprise applications, which is maybe highly redundant, highly stable, but not as out there as far as like pushing an algorithm. Yeah.
Hi, Don. So you mentioned the financials do matter, but the title of the topic is Growth Through Digital Acquisitions. We're finding a lot of the companies that are being acquired are profitless today. So how do we square that? And then also for James, I guess, a DeepMind might be an example of one where maybe doesn't have direct relevance to the search, but clearly it's a growth vector for you. So maybe some color on that.
Yeah,
I forgot to also ask if you would introduce yourself. That's Derek from Orange Silicon Valley, who's awesome, by the way. Thanks for being here, Derek.
Thanks, Derek. Yeah, we actually talked about this last week. Rocky, you want to take a shot?
Yeah, I think if it's we're buying it for the future. They may be losing money now, but the question is, what can we do with it? When we bring their capabilities into our company, and we may have projects that we want to add to it and resources that we add to it. And so ultimately, we're looking at the long term. What can we do with the company? And really depends on. We believe that we can grow with it. Most of the companies they're growing, or they believe they're going to grow. And if we have that mutual belief, we can still run financial numbers on it to show that it's going to get the return down the road. Now, when it gets a little bit tricky, if it creates dilution, publicly traded, that can be a big challenge. And so, if it's dilutive, it gets a lot more scrutiny. But we wouldn't be looking at it if we didn't think that there was growth of the two companies together.
And time horizon matters, right? So yeah, it can be unprofitable now in 5 years with that growth trajectory. like low marginal cost, you can easily see that becoming profitable. So that, and sometimes software companies, they're chasing many different things, and that's why the cost base is so high. They're kind of going that end market, different solutions, and you can sometimes bring just clarity and focus. We're going to this end market, and sometimes we can give them some platform and channel to that market, so you can actually quickly get to something that was unprofitable standalone to profitable as part of a bigger enterprise.
We certainly see that. I mean, oftentimes a very small company who's not making money, but they drop in and they're part of a feature set that is now, part of a global, larger offering. That is something where we see an instant return. I think oftentimes engineers are really struggling with the scale that we work on and the size. They were solving a problem for hundreds of users, and when you address a billion, it's a different kind of concept there. But it is a high impact. I think for the question around DeepMind and some of the other ones is we definitely set aside a chunk of our funds and think about long-range bets, and that is a lot longer horizon. And we're willing to kind of take these leaps of kind of faith that there'll be something at the end, and we do see that. We saw, when we bought this tiny little company called Android several years back, it was like, why are you buying a mobile operating system? It's a huge platform now. So we have several of those in our history. We also have several that failed. And that's okay too.
Other questions? Right here.
Yourself first as well.
Hi, I'm Abhishek Jain from Schneider Electric. So as we talk about some of this digital assets, and it seems engineers are the real assets there which are driving this, are there kind of some new mechanisms you're putting in place to secure them for longer term? Maybe Google is probably less of that problem because you have a strong brand name, but for some of the lesser known software companies, like Dover, probably is more known as an industrial company and not as a software company, probably the same case with my company. How do you kind of ensure that retention, kind of financial is probably one part, but from a structural or transaction perspective, and something people below the management level who are probably not part of any earn-out or those kind of schemes?
Well, we're going to build a volleyball court, I guess. Yeah, there are just retention mechanisms that are standard, right? Not necessarily unique to digital, and they still work, right? At the end of the day, it's a very valid incentive. If it's small and you're buying from owners, the earn-out structures kind of, let's participate in the success together. That resonates pretty well. If you can spell it out reasonably clearly upfront. Managing expectations up front. Obviously, many software companies, they will just, everybody freaks out that they will be part of some big corporation. There will be, just useless administrative tasks. And so you kind of manage expectation and kind of tell them, bring people who went through that process before, kind of calm everybody down. And your operating model, your management model, it's a choice, right? We are fairly diversified and decentralized. And we try to kind of keep people where they are, but we don't change kind of brand names. So not a lot actually changes for them. They just get a little bit more of a scale behind. And as I said, it's a choice that companies make how they integrate that acquisitions.
It's interesting. We did a survey about a year and a half ago. It's actually some of the stuff's back there, but 1,100 executives, and interestingly enough, 66% of them said that when they did a digital acquisition, they didn't integrate the acquisition into the broader company. So they were very cognizant of, I think, what you're driving at, which is how do we maintain, number one, all the things that the company's doing that I wanted to have as part of my portfolio, but also how do I ensure that I'm not going to lose everybody, right? So saddling it with this big bureaucracy maybe that they're not used to is critical. And I can tell you from personal experience, we did about 100 acquisitions last year as Accenture all over the globe. Most people don't even realize that because they're all really small. When we first started doing that a few years back, what we found was that it was great because we'd bring them into this big machine and drop them in there, and they just floundered because we just crushed them with the weight of this thing. And so our internal development people said, wait, we got to stop, because we're not getting out of them the value that we wanted because we are crushing them with this big thing. So now you see them carrying their same names, Bloom, Fjord, all the companies that we're acquiring to fix into this big animal we call Accenture. We're allowing them to operate to ensure, number one, retention, but also just to continue to drive value. So let's do a couple, oh, we got another one? Yeah, go ahead.
Hi, I'm Helen Jen, so I'm from Navistar. So we're a commercial vehicle manufacturer based in Chicago, actually. So, so our industry is currently experiencing a lot of disruptions. So we have autonomy, electrification, connectivity, and et cetera. So I actually have a question for Andrey. Sorry. So, because you mentioned, you know, you're also from a traditional manufacturing company. So you have experience, you know, kind of integrating or looking, evaluating different, you know, new technology companies. So I just wonder if you can comment from your experience how you evaluate these new technologies, which you don't really have a lot of resources internally, you know, in terms of evaluating how viable it is, and also how do you kind of compare different companies and select the ones that will, you know, be most likely to be successful in the future.
Right. I mean, it's always a challenge with new technologies, and I mean, I think it's probably double challenging for an industrial investor. We don't have a kind of venture capital type mandate, kind of place 10 bets and hope one works out and 9 doesn't just expectedly die. It's like, no, everything needs to work out in a way. That's just how shareholders think about industrial companies. And but at the same time, sometimes it's existential challenge. And you have to do something. I would say, I mean, our bets and technologies we expand into, you know, they're not as not deep mind level, right? It's sort of maybe put a sensor on a pump and sort of measure its vibration. So it's a little more straightforward. And because of that, we can rely a lot on our operating leaders, kind of people in the marketplace. I mean, they see kind of they hear from customers, they see what starts getting traction, what do they really need, and in that sense, that gets us pretty good insight as to like what's real, what's not.
I think you know, just to answer it, when we've gone in to look at a company that may be a little bit further afield from where our business expertise is and the individuals that we have either in the CTO organization or in the business. We've looked at, you know, sort of outside advisors to help us out in that area. And then we've also, there are some organizations out there that try to, you know, that can connect you. You can give them, hey, I'm looking for, you know, people of such and such a profile that maybe have worked at these, you know, 5 companies in the past that we know are in the industry or competitors. And they'll set up, you know, interview sessions with them. You know, there's a fee associated with it, but you set up interview sessions and you learn, you sort of pick their brain about what they know about the industry that, you know, we don't know about. And so you try to get smarter that way about it. So those are kind of 2 approaches that we've used to, you know, try to address that question. I got nobody, I can't, you know, I can go ask, you know, I can go ask you about, you know, tell me a great powertrain company, you know, and that doesn't help if you don't have the expertise. Those are a couple of the tools we've used.
So let me jump to another question.
Just quick follow-up, sorry to interrupt, but do you have any specific names that, I know of one, but I wonder if you might.
I think one is Insight, and I'd have to go look for the other one.
Okay.
But I can get those to you.
Well, and I was introduced to Gearson Lehman by Peter Granite, who I know has done a lot of work with GLG. I think it's you know, those are.
Yeah.
So if anyone else has any other specific names, because that does sound like a great resource in particular for the customer insight and to understand.
You know, it's hit or miss. I mean, you can be on the one, you know, you can be in a phone conversation with somebody for 15 minutes, you know, okay, this is not going to go, this is not going to be the right one. And then there's another one that you'll hit and you go, boy, I could like to talk for another couple hours, and, you know, usually you can make that happen.
So let's turn a little bit. So let's talk about, as you're doing the transactions, how heavily involved are your business unit leads in your due diligence and your acquisition kind of activities? in that versus, kind of driving it from a corporate development place. So the business unit leads may not be really skilled or knowledgeable around transactions in general. Talk about the trade-offs and having them involved, the pros and cons, kind of the challenges. Andrey?
Well, as I mentioned before, right, so first, Dover operates 20 almost unrelated businesses, right? We make pumps, refrigerators, printers, garbage trucks. I mean, there's not a lot of commonality. Like, there's no way I can know all of those markets, that closer. Like, and especially as it comes to kind of these cutting edge, like what's really new, like what's happening. So we rely on business leaders to really come up with that kind of cultivation, with the ideas, and cultivate relationships. So, I mean, they had same trade shows, they are kind of pitching same customers, so they develop good relationships. And then on that stage, we partner with them just kind of as a sounding board. Is that, like, can you articulate the business case that I can sort of go and take it to my board? And later on the execution front, obviously, like that's where we step in much more in terms of just process, diligence, documents, and all that.
We certainly look for strong sponsor support. I mean, that's actually one of the key things that if we don't see it, then we actually, that gives us pause. That's our earliest indicator if a deal is going to be successful or not. But that said, we also, as corp dev, they may we're a company of engineers, and they fall in love with technology, and sometimes it's not how you monetize it. So there's a little bit of sometimes where we have to be that other counter voice. And that's something we do play as part of that conversation. And then we also do a bit of kind of representing that. Because we do that voice, we'll kind of provide a counter to, we'll have in a very googly way, a sponsors sort of googly pounding the table. And then we'll be kind of providing kind of the other counterpoints of here's some of the issues, here's some of the concerns. So in some ways, we're almost a little de-accelerator at the beginning to make sure that we get that. But as soon as we kind of decide that this is the deal we want to go through, then we're pouring resources on to make sure that they get it. We also have the benefit of a pretty large percentage of our population has either been in an M&A acquisition because of being in the Valley, or has been acquired by Google. I mean, in some teams, I can't quote the exact number, but it's maybe as many as 1 in 15 in the team have come through an acquisition. So sometimes in that conversation, there's already somebody who's been acquired. So there's another voice that I think helps in that kind of, it's a lot of work. It's not coming for free. There's a risk.
Yeah, I would say, similar to Andrey, we look for a business unit sponsor. When I was in strategy, it seemed like everybody's answer to strategy was go buy something. It was the easiest thing to do was go buy it. And we, sort of have to, on the corporate development side, sort of explain to them, okay, there's a lot that comes with it, and there's a lot that you need to do. But, we look for a business unit sponsor. If it comes from strategy and we're trying to nudge a business in a certain direction, we'll work with strategy to sort of help get the business up to speed and help them get on board with why we're looking to acquire in a specific area. And we'll play a support role there. And then as we work hand in hand with the business through, the initial high level, what the financial case looks like. When we get into diligence, we tend to use a group, all the expertise, all the different functions. We sort of try to avoid throw it over the wall and hope they catch it. So we get them involved on the diligence side up front. But there's always a business person in there. There's sales, there's R&D as we're going through that process. So that by the time we get to the acquisition, everybody should have a really good feeling or a good understanding of what they're getting, what the approach to integration is, things like that.
James, you talked about, there's challenges with having them in there too. So how involved are they in the value case itself? Or is that really driven by corporate dev and then you kind of walk them through it?
It's usually, most of the time, the valuation is done by us and then our corporate finance team. And that's kind of another set of check and balances there. So definitely, because there'll be this is going to solve the world. It's going to make the greatest thing. It'll be, you love that engineering enthusiasm, and then it's kind of okay, but it's going to take us 9 months to get it onto the platform, and we think there's a key issues around the data that we could bring in, those kinds of things. So it does help kind of ramp it back down, but back to that kind of the more we can have other people that have been through it or either done an acquisition and bought for Google or been acquired and said, there's truth in that. They're going to make you fix all these things.
Right.
It just helps kind of get a more pragmatic view so that it's not just, yeah, please go buy something because strategy is the answer. We have had our episodes where we bought just about anything that walked by the door, and that didn't work out very well. We thought we'd stick it all together, and it just didn't kind of come together. So I think that was a lesson we took away from that.
I think on our side, with the business unit leaders are involved because our executive committee ultimately is going to look to them to follow through on the numbers, and our board is going to ask, our board asks regularly for follow-up on the larger acquisitions and how are we doing versus the business case that you came and said you would achieve. And that's a lot of why we get the business leader involved. And it's a process where, we'll ask them for what they think it's going to do, and then we'll say, okay, that's great, but you're going to have 120% of the market then, and it's probably not really realistic. So it's a bit of a give and take, and we generally end up on a reasonable business plan that, they're not over-committing when they don't need to, and make it something that they can achieve.
Good. Andrey?
I think I responded to that in the
So
beginning.
same kind of thing, yeah.
Yeah.
Okay, good.
Questions?
Hi, Jenna Sandin from IBM. I'm curious, from each of your organizations, how often do you have multiple lines of business sponsoring a particular deal? And what's your approach in either assigning out or doling out the business case post-close results? How do you manage to that?
Easy answer for me, very rarely, because the businesses are so unrelated. There might be some, overlap, like while we are buying a company and they're actually your supplier, so kind of uncover some synergies. But it's typically a small part of kind of the thesis.
We actually really struggle with that because there's definitely challenges there, and we kind of try to move the mass to a center of one key sponsor and then kind of have the others as secondary. But we've had very mixed results of that, to be candid. I mean, it's something that we just have not. We've looked at even kind of dividing up the organization a little bit, but then when you divide it up, then you lose the functionality or the synergies. So it is not one that we have done historically very well yet. It's one that we keep asking how we can get better. So if people have suggestions, I'm all ears.
Yeah, I think most of ours, there's a clear business owner. There's a couple that I can think of where we've got a product organization and a software and services organization, and it's you need the product to get the service and the software sale, and we spend a lot of resources to divide up, okay, how much goes into product and how much goes into software and services. And I think, like James, I don't know that there's a really easy way to do it.
Hi, Derek Beatty from Caterpillar. How do your organizations think about acqui-hires in terms of valuing, structuring, evaluating the assets you'd be acquiring?
You may do it more than
we do a lot. Sorry,
the most.
I think the first comment is this is a very expensive way to recruit. Although I think there is a value if you get a whole team or a key set of leaders that you can then kind of have a clear objective and have them go forward. That makes a lot of sense. But I think there is you also can struggle with kind of that if you bring the small group in and they're dropping them into a very large organization. I mean, Google's now 80,000 people. They can get lost. So you need to make sure if you're going to have an acqui-hire that you have a very clear sponsor and a clear leader who's going to say, I'm taking this group and bringing it under my wing, and I'm going to get this value out of them, because I think that is it's easy for them to get lost. I mean, and even a little demoralized. I mean, they were in a small, tiny little company, probably doing something really cool. Now they're in something big, and where do I go?
And maybe you're using them for something different.
Yeah, exactly. Yeah.
They didn't succeed at what they were doing, but.
Yeah, and they're like, okay, I really just want to go back to doing that, and then and maybe that's not what we've all decided we want to do, so, or what we've decided, yeah.
Yeah.
Yeah,
Hi, Peter Granite from SAI Global. What's the role in your organizations for Corp Dev post-close? How much responsibility, accountability do you have to chase down synergies and make sure things happen in the first 12 months? Maybe you can just comment on that.
Andrey?
Yeah, well, we have a well-documented kind of integration playbook and process, which we help kind of deploy, and then I participate, with these monthly integration calls, kind of just to monitor what's happening, and then we report to our board regularly on kind of, we have a set format of kind of scorecards against like what we committed to and how we're doing against that. So that comes through our corp dev department as well. But the bulk of the actual integration work is done by the businesses, right? So it's a monitoring role, I would call.
So
Go ahead.
I think in our case, we've got, in the corporate development group, there's a couple of individuals that are in what we call the integration management office. They have the playbooks that we use on the deals. We, as I said, we have a group that does the diligence. So all, HR, IT, finance, they're all asking the questions of the target company to understand what it is that they're getting, knowing how we want to operate it afterwards. And then a lot of times those same people that have done the diligence are the ones that are participate in the integration management calls, which will be really on a weekly basis, where they'll go and they'll talk through, okay, here's the integration playbook, where are we, what's the target when we're going to get to, it's different for each function, and each deal kind of may change as to when we do full integration on payroll and full integration on IT and get them on the ERP system and things like that. But they sort of coordinate all the different resources across the functions in the corporation. And then, and then a lot of that's on the blocking and tackling, but it also gets into the blocking and tackling necessary to achieve the synergies.
So for us, every deal has a series that we manage by OKRs, and so every deal has a series of OKRs. So on one level, if the OKRs are being ticked off, then that's when we do the handoff. That's the short answer. We have a team of integration folks in the corp dev team that's actually almost equal to this number of deal leads, and we stay involved in the deal until all those are done or until there's somebody fully catching them. And that can be anything from acting as an interim COO for a period of a couple years, in some cases, to actually one of my teammates has never given away his deal yet because it's not quite done yet. And so he goes and meets with that team every Monday and works through more integration issues because there's still a lot there. So it is a little bit of a elastic piece, but when we feel like the host organization and the sponsor organization is in a place to catch it and it's well managed and maintained, then we will step off. But yeah.
I think the bulk of our clients typically hand it off out of corporate dev to another group, just as a rule. And specifically when it comes to digital, there's oftentimes not a lot of integration that actually happens. So it's a little lighter touch, so you get a little mix there. But when it's a real heavy lift, like a large acquisition or a big merger, they usually hand that off.
Yeah. The example, like for Timely, that was 30 days. They came in, started working on the engineering team. They were off to the races. Yeah. It's done. Yeah. So that's a short one.
Good afternoon. My name is Abik Jain. I work for IDEX Corporation out in Lake Forest. So similar to Dover, it's an industrial manufacturing business. We actually have 40 companies under the IDEX umbrella. So Andy, a question for you. When you look at technology acquisitions or digital acquisitions, are you looking as much as you can sort of company-wide? So, can I apply the same technology to different industrial businesses, or is it more sort of by company?
Yeah, it's a good question. Yes, I think we aspire to do that more. The reality is, especially the more early stage it is, the more probably kind of focus it will be on a given vertical. But we do always kind of probe and encourage people to think, well, where else can we go with it? I mean, I'll give an example. So we bought a couple of years ago a company that makes kind of cameras and video monitoring solutions we make garbage trucks, right? And now all garbage trucks have cameras around them and inside monitoring the driver for signs of fatigue, any kind of erratic behavior, everything that's happening around. If there's an accident, you have a proof of insurance, and then now you can send a confirmation to the client, I picked up your trash, or it was blocked, and here's a fine for you. And then, so that's a vertical, but that's applicable to many other verticals, right? So yeah, that's always, I don't know many successful examples of that, so that's why I called it aspirational.
So question, so how often do you look at a digital acquisition and think about using that to reinvent your company or a business within your company? Rocky?
I would say that, we've been, the acquisitions that we've done lately have really been in the software and services area. So historically, we've been a telecommunications equipment provider for mission-critical communications. And there's been a strategic drive to get more into the software and services area. So we've done, besides some organic stuff that we've done a lot of acquisitions that have added on to the software capabilities that we've had. And it drives it gets more revenue in that area, but what's more interesting is that it drives a different conversation, and it drives, different possible acquisitions because the adjacency changes. As you bring on somebody, and we don't really do anything that's really far afield. We need to have some adjacency for it, but when you add on, the first adjacency, then you have the second adjacency, and then you're further away, and you're starting to have different conversations because they all have ideas of here's where we could grow that we wouldn't have thought of in prior to that acquisition, for example, or maybe not had the conviction that the new acquisition has that's an area you need to go acquire in. So that helps to reinvent and change the conversation, which then opens up more possibilities for where the company can go.
Right. James?
Yeah, we have a couple mechanisms. I definitely think for technology, like the Timely example, it's a tuck-in, and that's a quick, simple solution. But if it's something that we look at and it's really unique, like the example of DeepMind, we'll leave it as a standalone. I mean, that's an opportunity for us to see it, observe it, watch it. And we have a couple places where we can park those. It's just that with Google X and Alphabet, we can create an Alphabet and leave it completely alone. Or in the case of Waze, which is not fully an Alphabet company, it's kind of half in Google and then half with Maps. And it's a little bit of a blending so that we can kind of let Waze do its own thing and let Maps kind of do its own thing and then figure out what really makes sense. And there's merging now, but that's a deal we did 5 years ago, and we're still kind of working through kind of assessing that. And so, yeah, if we see something that's really, one order or two orders away, our tendency is to leave it alone and watch it and incubate it.
I think our strategy is, I would say, kind of incremental compounding, right? So we don't want to swing for the fences or be in a position where you kind of missed something and now you have to, right? So for old economy companies, it's important to start kind of thinking about that early and kind of constantly kind of monitor so that you're not in a position where you have to now buy growth or, there is existential crisis. So we do incremental, and we are patient to kind of wait 5-10 years, and where those incremental improvements to the solutions, then in the end, oh wow, 10 years later, it's a completely different business.
Right. Okay. So we talked about financial and your valuation and kind of your due diligence. When it comes to the actual integration, kind of playing on a question that was asked a minute ago, do you find it's better to have a standard playbook irrespective of, what kind of transaction you're doing, or are digital acquisitions, do you have a separate playbook for that? And then for a more traditional kind of deal, you use a standard playbook for that as well?
I think, when we've been doing a lot of software acquisitions, we had a playbook for that. I would say there's one sort of broad playbook that will adapt to the specific acquisition, but lately it's been a lot of software services type acquisitions, and we've got a playbook that works fairly well for that. And each deal is different. I mean, sometimes we've integrated them right away. Sometimes they've been separate for a while. So, the value of the playbook is to sort of say, okay, here's all the decisions you kind of have to make. Here's all the things you need to think about. But each deal, you may, when you get to the end state may change, and that end state may be a little bit different. But there's a lot of, the functions that are fairly straightforward regardless of the transaction.
James?
Playbook is one of those words that gives the folks heebie-jeebies at Google. We say oftentimes that every deal is a snowflake, and we do see that there is some overlap, which I think is the key. So what we focus on is actually having a series of tools in the box that are more parts of those programmatic pieces, but we will then reshuffle those based on what we plan to do with the deal, how fast we plan on integrating it. So there is an awful lot of overlap, but we do reserve the right to kind of completely change the order or completely tune it just because of, there's something that we want to accelerate or something we want to de-accelerate. We use some broad categories to kind of align people, but each deal's pretty bespoke.
So probably 70% of the process and approach is similar, but I think there's increased, teams and boards are more sensitized to issues around IP. Is it real? Who developed it? Who owns it? Is there an infringement, right? So there's like a whole layer of work around that and a few more tabs in diligence requests and in integration, some of the discussions around retention, like you're really buying often talent, and kind of how closely to integrate it. That's kind of another kind of more pronounced layer of discussion compared to general industrial.
Right. So following up on this, a couple of these questions around retention and stuff, what would you recommend from the standpoint of how do you handle cultural differences between the existing organization and the digital capabilities that you acquired? What's some of your make sure you do this kind of questions, or maybe even more importantly, please don't do that?
I would say that on culturally, it really is kind of where it's going to sit within the organization, and this goes back to the business leader ownership. We've got a software organization that our software acquisitions can fit into. So there's sort of a similar thinking, and we're buying something that's somewhat adjacent. Maybe it's it fills a portfolio gap. So there's generally some commonality of thinking. When we have had some potential cultural issues, we've tried to deal with them, before we do the acquisition and sort of have the tough conversations with, either the owner who is going to have, they're not going to own it and call all the shots anymore, and trying to have that conversation up front with them. That's one of the ways that we've tried to deal with that.
Great. James?
I think building on that, I think at the core, we find that where we see cultural differences is how things get done. And I think talking more explicitly about this is how things got done before the close and this is how things will get done, or how we want to make things work after close, is really important, because oftentimes people are like, oh, well, it's not really that different, but it's just a different little bit. So it kind of de-emphasizes some of that culture issue. The other one is that we have this real strong bias to increase as much surface area with the new team and with Google. So we'll do everything from embedding engineers into the organization up to a 1-to-1 ratio in some cases if we have to, or rotating them through different organizations so they understand not only the why we're doing it or the how we're doing it, but why we did that. Because I think that's the other piece, is oftentimes engineers will, it doesn't make any sense. And if you get to the why, then they're like, oh, I get it now. It's like, here's why we're doing this, because this was a problem a long time ago. And this is our nature. So I think those are the things that kind of ramp that down. And
and I think we'll look for opportunities to take engineers that maybe we've acquired and put them with another team to help solve a problem.
Yes.
So that we start cross-fertilizing the ideas and start, everybody's, oh, okay, you're not that different, and and there's more commonality than maybe they think there is. Right.
We have it when we've had some high-risk deals where we wanted to really do something big. We actually created a throwaway project that we put them all on, go do it, figure this all out. They figured it all out, then, hey, we all work together. Then we sent them off to go work on that really tough problem, because they were all formed at that point. They figured out how to work. So
kind of structure the communication early so that there's lots of communication, and then also kind of force the interaction, the collaboration, so that they develop those relationships.
Yeah, right.
Andrey?
So that's a hard topic, and lessons are hard learned. Transparency up front definitely helps. And keeping people, sometimes even physically, going back to that, not integrating too aggressively. Unrelated to M&A, but Dover opened recently a digital center. It's a group of engineers and e-commerce specialists. I mean, it's not DeepMind, but kind of putting our pump catalog on online, things like that. And it's in Boston, right? And it was part of that is just talent base. Not to disparage Chicago, but Boston was deemed better, but also just create some of that physical separation and let them do their thing. And also, especially if you're buying a small company, you can create an exciting narrative for them. Like, look, you're becoming part of a bigger platform, and it will be easier to do some exciting things now that you have channel, you have access to some blue chip global customers, and things will happen actually faster in your world. You know, you'll not, if you're buying from an owner, you'll not have to deal with accounting, lawyers, and all that. There's good value proposition, right?
Yeah, I think that's what we find too. I mean, the things that you guys are talking about resonate really well. When we do post-deal kind of analysis for clients, we find they didn't communicate as well as they thought they did, right? They think we're good communicators. No, not so much. We're good at change. Not so much, right? And then that interaction, building those relationships early by getting the teams close together, those are all things that really kind of jump out the page at us when we talk to people about how this deal go. And, you know, the executive team has an idea how it went, and the people that are really doing the work have a totally different view of kind of how it went. So I don't know if we've got time for a few more.
A few more.
Okay.
Thank you so much. I'm Anoop Tiwari from Cars.com. I run the strategy and biz dev team there, and we also do corp dev. We talked a lot about integration and post-close evaluations and so on. I'm curious to go back to the origin of the deal. So almost all of you talked about the need for tight integration with the strategy. Do you guys mostly see deals come from your business units and strategy teams? Or are they mostly coming from your side, either inbound or ideas from your teams?
You know, I would say, so we have a weekly meeting with legal, strategy, and corp dev. And then I know that the strategy team will meet with the business executives on a regular basis where they talk about, the whole purpose is, talk about the acquisitions. What's come in inbound unsolicited, if it's still active, what are the ones that are, what we say in the pipeline, we're, sort of working on the acquisition thesis, we're, maybe, we've signed an NDA, we're working towards an LOI or things like that. And we meet and we talk about that on a weekly basis. So it comes from, I would say it's probably 50-50, either coming from, the corporate strategy / an inbound versus coming from the business.
We organize around product areas, so we'll definitely, part of our corp dev team is part of the strategy arm of that product area. So we sit in those conversations regularly and kind of understand kind of key pieces. And definitely the engineering team brings a lot of leads to us of, hey, I saw this, or boy, these people are really doing something interesting. The other thing that's kind of unique to Google is that because of who we are, we just get about every inbound that can possibly there. If you're thinking about selling yourself to Amazon, hey, send it over to Google and Apple at the same time. So we probably get a...
Google's got lots of money. Send it to them, right?
Yeah, there's that, I've seen some... Do you know what we do? So, we probably have 100 or plus inbounds a week that we process. So that's something we do get pretty fast at. We've actually built our own tool so that we can actually look at it like, oh, we did look at that company, so we can give them an answer. But yeah, that's a little different. Yeah.
I agree. It's probably 50-50 in our case as well. There are still some of these small targets that are under the radar, and or sometimes the business leader will, oh, I didn't know they were, venture funded or would consider selling, right? So like they would never even kind of think about approaching them. But then it kind of surfaces through investment banking.
Hi, I'm Kyle Shinnick. I'm with Ryerson, or a metals company here in town. Quick follow-up on that. Do you see differences in the integration after the fact, or the success of deals based on your sourcing network? Like, do you see better results from some of those under the diamond in the rough type deals versus the ones you get through the bankers?
I don't know. I think most of the ones that, from my experience, the ones that are more successful are ones that we've sort of identified via the strategic process and through the interaction with the business versus the inbound unsolicited. You know, if the business is on board with it and it fits with the strategy, you've got two good things, you know, towards a successful acquisition.
Yeah, I was gonna say, I think that's more the case. I mean, the inbounds, there is a couple that were like, back to your point, oh my goodness, I didn't know they were even possibly there, and we really want that, and those are really good ones. But there's the other ones where most of the time there's a time pressure, so you're trying to make a decision very quickly because it's usually, you know, you've got a short fuse, and that tends to not always yield the right thing. I mean, you get a go buy fever and you talk yourself into it, and then you realize halfway down, we're gonna have to really pivot this thing. So.
I haven't looked at that kind of empirically, but intuitively, the proprietary cultivated should be positioned a little better, right? There would be some relationship. There is mutual understanding why we fit, and you know, why would they sell to us and not do a sort of broad process. So it should be set up to do better, I would say.
Okay, I'm going to take the liberty of asking the last question. Quick recommendations. You've mentioned capturing best practices in terms of a playbook, and you've talked about managing the deal pipeline. Can you recommend any particular tools other than Excel or an email inbox to do that effectively?
Well, we use I saw there are some vendors there that we've looked at. For now, we use the pipeline tracking. That's kind of built on top of Salesforce, basically. So it's Salesforce engine, but for M&A. So you kind of track all the interactions, you know, tag emails, and different people can contribute. So then you have the history in one place, especially as people change over, and you know, I can go back and see what was going on 5 years, who talked to that owner, right? So in terms of more kind of diligence execution, we've looked at some of the solutions, haven't adopted yet.
We wrote our own.
Shocking. and I would say we've kind of, you know, just built ours up using, you know, office productivity tools over whatever years of sort of doing it. So.